Thanks, Mitchell. All right. Good afternoon, everybody. Thanks to Mitchell and the Continuum Ag team for having me here today. My name's Paul Nees. I am Vice President of Global Supply and Trading for Chevron Renewable Energy Group. Originally from Ralston, our headquarters now are in Ames, Iowa. I should have went back before and said, I talked about Chevron. Chevron acquired REG 2 years ago. So what we recognized is that REG had done a lot of growth on its own from doing some acquisitions and organic growth and really growing out our capabilities of providing more biodiesel and renewable diesel to the marketplace. Chevron has a belief in a lower carbon fuel is the future. And so to really kickstart that growth, Chevron looked around and said, how do we really make this happen in a bigger way? And came looking for REG. REG was trying to grow as well, and if you combine the infrastructure and the capital and the engineering know-how of what those two companies bring together really makes a great opportunity for grow our business together. And so that's what we saw as an opportunity. So with Chevron acquiring REG, but able to continue that growth in the last couple of years, and we expect more of that going forward. So as I said, Chevron really does believe in a lower carbon is the future. We have the investment in Renewable Energy Group allows for the growth that we see in biodiesel, renewable diesel, exploring opportunities in sustainable aviation fuel. We see other investments along there as well, all at different stages of commercial development, but it really shows there's an all-above approach to finding better solutions, lower carbon solutions for what we need in the future of energy. We see a lot of opportunities in different areas to grow the lower carbon fuels business, and we're looking at all different ways to do that. So a little bit of the numbers behind that. As I said, we have 9 total refineries, 7 in the US, 2 are in Germany. We have one of those facilities is a renewable diesel facility based in Geismar, Louisiana, and the rest are biodiesel facilities. We also have a petroleum refinery in El Segundo, California, which is basically Los Angeles. That refinery has a portion of its refinery that can produce renewable diesel as well. And so when we see the right market signals, we can flex back and forth between producing fossil diesel or producing renewable diesel. And that's really a trend we're seeing across the industry. As we've seen higher demand for renewable fuels, stronger margins in the renewable fuel space, we see more companies that have refining assets looking for ways to convert those into renewable diesel assets. There's potential for better margins, particularly for some of these historically fossil diesel refineries that struggle with margin. Maybe they have a poor location or are not ideally located. There's maybe better opportunities to produce renewable diesel at those. And so that's really kick-started growth in the production of renewable diesel across the United States and really globally as well. So we'll talk a little bit more of that here in future slides. Participate in the methane capture off of the dairy cows. So 220,000 cows, we're turning cow poop into natural gas. And expect that to continue to grow as well. There's strong incentives for that. We see some great opportunities to keep growing that business also. Okay, so share some views on what we see in the renewable fuels landscape. So I think most people are pretty familiar with what's happened in the history of corn ethanol production, how that's really driven the increased demand for corn. We're seeing a similar type of trend happening in biodiesel, renewable diesel production capacity. We have refinery conversions, like I spoke about earlier. We also have companies investing big dollars into building greenfield renewable diesel production facilities. If you look at the chart, you can see how much capacity, this is actual production, excuse me. This is EIA and IEA government data, how much we have produced and what the production forecast looks like for the next 5 years. That's a significant increase in production capacity and therefore a significant increase in the demand for renewable feedstocks. SAF is a part of the growth, but really the big bulk of that growth, according to the government numbers, is going to come from renewable diesel and these new refineries that some have already started up and some are under construction and plan to be starting up in the next couple of years. So this is underway. This isn't going to happen. It's happening now, and it's going to continue to happen over the next couple of years as those projects complete and come online. We're going to see more capacity hit the market. So it's been led by increase in production capacity, but there's also been support of state policy to go along with that. Here in Iowa, we have very strong policy for incentivizing the production and use of biodiesel. We have other policies in Minnesota and Iowa that have also supported the growth in consumption of fuels in those states. And then you may have heard about the low carbon fuel standard in California has been a big driver for the demand for biodiesel and especially renewable diesel on the West Coast. And we see those programs expanding up and down the West Coast into Oregon, Washington, and British Columbia. And that's really driven an increase in demand for these renewable fuels. In fact, in California, last year, over 50% of the distillate supplied to the market was renewable content. And that number is expected to grow substantially in the next few years as the demand, as the carbon reduction standards increase every year. It's going to drive higher demand for renewable diesel each year because of that. It hasn't all been rosy, though. There's been some challenges along the way. The biggest one being is the RVO, the renewable volume obligation, has been relatively flat. We got small increases in the RVO that the EPA gave us for 2023, 2024, and 2025. So we're living through that period right now. At the same time, we're having a big increase in renewable diesel production capacity come online. So what that's led to then is a reduction in the demand and the price for the RINs. The RINs are renewable identification numbers. That's basically the credit trading mechanism for these renewable fuel products. And so as the demand for RINs goes down, we have a bit of an oversupply that's led to compressed margins. That's tightened up the margin environment for all biodiesel and renewable diesel producers in the industry. We've been a part of that. So we had 2 plants that we unfortunately had to close this year. One plant in Ralston, Iowa, the first plant we started up, and one in Madison, Wisconsin. Those have been on indefinite idle since the start of the year. We've been in a period of poor margins, and we had to make some tough choices there. But that's really what we're facing is a period of overcapacity and therefore declining margins in this time period. But there's plenty of reasons to believe it's going to be better. There's significant policy things that drive margins and decision making in our business. The number one thing we're focused on is the RVO, the renewable volume obligation. As I said, we advocated for much higher numbers than what were delivered from the EPA, but we have another chance here to help influence what the RVO can be for 2026 and going forward. So we have some great champions from the state of Iowa and the federal delegation and helping making the message to our regulators that we have the capacity, we have the supply of feedstock, and there's no reason to hold back the growth in renewable fuels. There's a lot of potential for us to grow if the EPA will let us, and that's the message we're trying to deliver. Some more acronyms here. We're transitioning from a BTC to a CFPC. BTC is a blender's tax credit. Every gallon of biodiesel and renewable diesel today receives $1 per gallon tax credit from the government. That rule will end at the end of 2024, and the CFPC will take over. That's the Clean Fuels Production Credit. That's going to be a variable credit that'll be applied to all production of biodiesel and renewable diesel in the United States. And so there's 2 major changes. Imported biofuels does not qualify for this credit, which it does today. It will not start in 2025. And the value of the credit will be variable based on the CI score of the fuel that you produce. So things like used cooking oil, distiller's corn oil from ethanol plants, and animal fats all have strong or lower CI scores and therefore generate more tax credit value than things like crop soybean oil. So we're starting at a disadvantage with soybean oil. Things we can do to reduce the CI score that helps with 45Z and all the stuff we talked about earlier today also helps in the biodiesel industry with getting a better tax credit in each gallon that we produce. We do believe that this change in the law will help with our margin environment because you're going to see less imports come to the United States. The imports will not qualify for that tax credit. So we see some upside because imports in the United States have been pretty significant in the past couple of years. And so we think a lot of those imports will be pushed back and allow for more growth in domestic production capacity. And then lastly, on state policy, I talked a little bit about that earlier. There's constant discussion around what we can do around different state policy, and all states are kind of in different stages of wanting to have that conversation. What's a little bit unique here is we can stack the federal policy and the state policy on top of each other in terms of what value we can deliver. And we're almost getting this point now, depending on what gets delivered from the EPA on the RVO, where the state credit volumes could be incentivized to be larger than what the federal volumes are. So obviously we want the RVO, the federal number to be the big as we can get, but we also want to keep pushing the state policy at the same time because we can grow volume, grow demand from both angles. And how do we tie this back to agriculture? So a couple things. Chevron has also made a strategic investment into a joint venture with Bunge. So we are JV partners in 2 crush plants, one in Cairo, Illinois, one in Destrehan, Louisiana. And so we can get better integrated into our feedstock supply and get better insights into how the veg oil supply can feed our facilities. We made an exciting announcement here a couple weeks ago. We're going to be expanding the crush capacity of our Destrehan, Louisiana crush plant. And that crush capacity is going to be flex. And so what that means is instead of a traditional soybean crush plant that can only crush soybeans, this can go back and forth between soybeans and crushing smaller grain seeds such as cover crops. And so what you have is kind of a chicken and the egg kind of thing. You have to have cover crops to produce more seed to have the reason to invest in crush, but you also have to have the seed to make the investment. So we said we're going to make an investment, the acres will come. And so we've talked about cover crops earlier today and what it does for soil health and all the other benefits. What we really see an opportunity for is these cover crops can also be a cash crop. We want to be able to harvest these crops, grow an oil seed that can be harvested, and that provides more oil and more revenue to the farmer, more oil to the biodiesel producer that can produce more lower carbon fuels. Because if you look at that chart and all the growth we saw in the renewable diesel capacity, we need more veg oils, we need more lower carbon feedstocks to feed that growth. We think cover crops is a part of that solution. Cover crops take some time to develop. It's going to take the seed genetics, growing out, getting the acceptance with the farmers, and the seed collection, all that stuff takes some time to do. And we don't know which one's going to necessarily be the winner. Not all cover crops work for all farmers. And so we've made multiple investments into different opportunities here, and we see that as a real opportunity for us to grow the supply of veg oils and help provide more revenue to farmers in terms of a cover crop that can be harvested for profit. So to tie it back together, we have a lot of challenges in front of us, but we really see this as a partnership. I think what Chevron REG does really well is takes low carbon feedstocks, is really efficient at the conversion of those feedstocks into renewable fuel. We're really good at finding end markets that will pay the best value for those fuels. And we have a very efficient logistics process. We need more supply to fuel our growth. We need policy to fuel our growth. Chevron's a big company, but this is something we can't do by ourselves, right? So we need help, we need support, we need everybody's buy-in to make these types of things happen. So policy really matters to our business, and the louder our voice can really be helpful. So we're always looking for partners and reaching out to find folks that can align interests with us and really get people energized about this. So we need a higher RVO. We talked about that earlier. We want to see lower CI feedstocks available for us to process. And as Senator Ernst just said, a science-based approach, not a political approach. 100% on board with what she just said. We really see some good opportunities for us to partner with people that can produce lower carbon feedstocks and make them into lower carbon fuels, because we know what we do well. We need others to provide the feedstocks to us. The food and fuel debate, I think, has been squashed and come back up again and squashed a couple different times. There's plenty of both, and we really think there's plenty of opportunity for us to grow the production of renewable fuels without harming the available supply of food. And just collaboration, climate smart ag, that's what we're here to talk about. We see there's plenty of partnership opportunities for us to continue to grow there. So I think that's all I have. As Mitch said, we'll take questions later on, but really appreciate the opportunity to speak in front of you guys today. It's great getting to meet a few folks in the hallway as well, but look forward to speaking with you later this afternoon as well. Thank you.
Paul, that was really good, really interesting stuff. Since you got done early, I'll ask you the question.
Okay,
though.
go for it.
So the one was brought up before, and we'll let Tom kind of work up here. So obviously we've talked in this 45Z thing a lot about corn, but on the soybean side, I mean, the question was brought up before, like, what should we be doing on soybeans, or like on the on-farm pieces of soybeans, or do we got to kind of wait and see a little bit?
Yeah, as you said, there's a different step in that supply chain process for biodiesel, renewable diesel compared to corn ethanol. And frankly, the CI difference and the value applied to that really isn't enough to move the needle right now. So we need to see more value in there. I think I heard a few people say earlier today that value has to be shared, right? Everybody in that value chain has to be motivated to do that. We're not going to do something unless it's a price signal to do that. And so we need to see more value to make things move. But I think there are some opportunities. We don't have them, but there are some biodiesel assets that have a crush plant and a biodiesel plant co-located on the same location. And I think if you have opportunities for farmers to deliver low-carbon soybeans to those locations, that traceability, paperwork documentation is a lot cleaner. And there could be some ways to share that value back to the farmers. Not all the industry is set up that way, and so you might not see that same opportunity across the entire industry. But I think where you have co-location, I think there's definitely some opportunities to share or have that tracking and provide it back. But you just got to keep in mind, all these things require traceability, documentation, have to stand up to an audit, right? And so anybody in that value chain needs to make sure that they're being provided value to do that type of work.
Maybe one other quick one. What I think is interesting, and what I was glad you guys were able to come to, is this Chevron REG thing, and with Bunge, like we're seeing this happen even beyond you guys' side of things. Obviously, you guys have been a leader in all that, and the collaboration, and companies getting themselves organized to do this at a large scale. Mm-hmm. I mean, you laid out some of what's driving that, but what else maybe are you seeing of why do you think there's multiple of these large organizations that are aligning themselves, right? We've seen, Phillips doing that, or Shell, or some of these others that are, like, you guys aren't the only ones that are aligning to that. Mm-hmm. You guys have gotten very organized in multiple steps, but any other take on why you see that all kind of happening all at the same time?
Well, I'd probably start by saying it's a tough business, right? And you have to have some deep pockets, you have to have some infrastructure, you have to have some know-how to make these things be successful. And I think it's a combination of that. You're starting to see some renewable fuels producers looking for partners because they're seeing some challenges in their business, and it's hard for them to grow if they can't find the right business partner. But you're also seeing renewable fuels traditional fossil fuel companies saying, what's my renewable fuel strategy? Like, we got to find a way to be in this. And they're all attacking that from different directions. Some are trying to do it organically themselves. Some are doing that through the route of acquisitions. And so they're trying to sort out what's their best way to be successful. But I think one of the real benefits that we saw is Chevron has a huge retail downstream presence, right? There's Chevron fuel stations, not necessarily in Iowa, but if you look kind of West Coast, Southern Coast, and even up the East Coast, there's a lot of downstream presence. So we have an opportunity to get our fuel directly into the fuel tank of our customers and not going through 2 or 3 middlemen to get there. And so you have that kind of supply chain optimization. You have all these great synergies that you get from putting together a traditional fossil fuel producer that's very strong in refining and distribution and sales. With what we do on the renewable fuel side, you can create a lot of shared benefit together.
I love that. Let's give Paul another round of applause. We'll get back up in a bit.